Picture this. It is October 1907. The United States of America, the fastest-growing economy on the planet, is 3 days away from complete financial collapse. Banks are running out of money. Thousands of ordinary Americans are lining up outside their local branches, trying to pull out their savings before the doors close forever. Some of those doors are already closed. The lines are getting longer. The panic is spreading from New York to Chicago to New Orleans to San Francisco. Every hour, it gets worse. And the President of the United States, Theodore Roosevelt, one of the most powerful men in the world, cannot do a single thing about it. Not because he doesn't want to, because the government has no tool to stop it. There is no Federal Reserve, no central bank, no emergency fund, no mechanism to inject money into the system when it starts to break. The United States government in 1907 has less financial firepower than a mid-sized European country. When the banking system starts to fall, the government can only watch. So, Roosevelt does something that no American president should ever have to do. He calls a banker. Not a general, not a senator, not an economist, a banker. His name is John Pierpont Morgan. He is 70 years old. He is worth more than most countries, and in the autumn of 1907, he is the only man in America with enough money, enough authority, and enough relationships to stop what is coming. What happens next is one of the most remarkable stories in the history of money. A private citizen, answerable to no government, elected by nobody, accountable to no law, takes control of the American financial system for 3 weeks. He decides which banks survive. He decides which ones don't. He choreographs a rescue that the government then ratifies because it has no other choice. America is saved, and Morgan walks away with something valuable in return. But we will get to that. First, you need to understand how a country gets itself into a position where one private banker becomes more powerful than its own government. Because this did not happen by accident. It happened because of decisions made over decades, and the consequences of those decisions are still shaping your financial life today. John Pierpont Morgan was born in Hartford, Connecticut. His father, Junius, was a banker. His grandfather was a successful businessman. Money was not a mystery in the Morgan household. It was a language spoken fluently from childhood. By the time Morgan was in his 20s, he was working in finance in New York. By his 30s, he was financing railroads. By his 40s, he was one of the most powerful financiers in the country. By his 50s, he had reorganized more bankrupt railroads than any man in American history, a process that became known on Wall Street simply as Morganization. Here is what Morganization meant in plain terms. A railroad goes bankrupt. Its debts are enormous, its creditors are panicking, its stock is worthless. Nobody knows what to do. Morgan steps in. He buys the debt at a discount. He restructures the company. He installs his own people in management. He cuts costs, consolidates routes, and eliminates competition where he can. Then he sells the restructured company to investors at a profit. He did this over and over again throughout the 1880s and 1990s, and every time he did it, he got a little more powerful. Every time he did it, a little more of the American economy passed through his hands. By 1900, Morgan didn't just participate in the American financial system. In many ways, he was the American financial system, and that created a problem. But to understand what that problem was, you need to know something about the United States in 1907 that most people are never taught, something that explains exactly why Roosevelt had no choice but to pick up that phone and call a private banker when everything started falling apart. The United States had no central bank. The first Bank of the United States had been shut down in 1811. The Second Bank of the United States had been killed by President Andrew Jackson in 1832. Jackson hated banks with a personal fury that bordered on obsession, and he dismantled the central bank with considerable satisfaction. He genuinely believed he was protecting ordinary Americans from the power of financial institutions. In some ways, he was right. In one very important way, he left the country completely exposed. After Jackson, America operated without a central bank for 70 years. What that meant in practice was straightforward. When a financial panic started, there was nobody to stop it. No institution could inject money into the system to calm depositors. No lender of last resort could step in when banks ran out of cash. The system had no safety net. And financial panics in the 19th century were not rare events. They happened in 1819, 1837, 1857, 1873, and 1893. Each one caused enormous damage. Each one destroyed businesses, wiped out savings, and threw thousands of people out of work. Every single time the country eventually recovered, and every single time nobody fixed the underlying problem. So in 1907, when a bank called the Knickerbocker Trust Company started to fail, and when news of that failure spread through New York like fire through dry grass, the United States was as exposed and as vulnerable as it had been during every previous panic. Except, this time the economy was bigger, the banks were more connected to each other, and the panic when it came moved faster than anything the country had seen before. It started on October 22nd. By October 23rd, it was a full crisis. By October 24th, Morgan was already in charge. Now, to understand what Morgan actually did during those 3 weeks, you need to picture a specific building on 36th Street in Manhattan. It was Morgan's private library, a beautiful stone building he had constructed next to his home to house his personal collection of rare books, manuscripts, and art. Marble floors, Renaissance paintings on the walls, shelves filled with some of the most valuable books in the world. It was a room built to project one thing above everything else: power. And it was in that room, in the last week of October 1907, that Morgan did something no private citizen had done before, and no private citizen has done since. He summoned the most important bankers and trust company presidents in New York, and he told them, in plain terms, that they were going to solve this crisis together. Not because the law required it, not because the government was ordering it, but because Morgan was asking. And when Morgan asked, people understood that saying no was not really an option. The meetings went on for days. Morgan sat in his library in a tall leather chair, smoking cigars, sometimes playing solitaire, while the men around him argued and panicked and tried to calculate how much money they were willing to commit to saving institutions they privately considered their competition. Morgan listened, he calculated, and when he had decided what needed to happen, he told them. On the night of November 2nd, the trust company presidents were locked in Morgan's library, literally locked in. Morgan put the key in his pocket. The men did not leave until they had agreed to a $3 million pool to shore up the weakest institutions. Morgan had decided the number. Morgan had decided the terms. The government of the United States was not in the room. By the time the crisis was over, Morgan had personally organized multiple rescue pools, totaling tens of millions of dollars. He had decided which banks were worth saving and which ones would be allowed to fail. He had called in favors from every major financial institution in the country. He had even intervened in the New York Stock Exchange, organizing a $25 million pool of cash to keep the exchange from closing when brokers ran out of money to settle their trades. The panic eased. The banks stabilized. The lines of frightened depositors began to thin. America had been pulled back from the edge, and the newspapers celebrated Morgan as a hero. They were not wrong. What he did in those 3 weeks genuinely prevented a catastrophe that would have hurt millions of ordinary Americans who had nothing to do with Wall Street and no way to protect themselves from what was coming. But here is the part of the story that the celebrations left out. While the crisis was still unfolding, while Americans were still standing in lines outside banks, while Morgan was still organizing rescue pools and locking bankers in his library, a separate conversation was happening, a quieter one that would end with Morgan acquiring something he had wanted for years and could not have obtained under normal circumstances. The company was called Tennessee Coal and Iron. It was one of the largest steel and iron producers in the American South, and it was in financial trouble during the panic, its stock collapsing along with everything else. A firm called Moore and Schley had used Tennessee Coal and Iron stock as collateral for loans. As the stock fell, Moore and Schley was facing collapse, and its collapse, Morgan argued, would deepen the panic further. The solution Morgan proposed was straightforward. His company, United Steel, the corporation he had assembled in 1901 in the largest business deal in American history up to that point, would acquire Tennessee Coal and Iron. That would stabilize Moore and Schley, remove a source of panic from the market, and strengthen the overall rescue. It would also give U.S. Steel control of iron and coal reserves that independent analysts valued at enormous multiples of the price being paid. There was one problem. Theodore Roosevelt had spent 6 years as president fighting the concentration of corporate power. He had sued Standard Oil. He had broken up railroad monopolies. He had built his entire political identity around the idea that no single corporation should become too powerful. An acquisition of this size by U.S. Steel, already the largest corporation in the world, would normally have triggered an immediate antitrust investigation. Morgan sent 2 representatives to meet Roosevelt in Washington at 5 o'clock in the morning on November 4th. Roosevelt was told that the acquisition was essential to stopping the panic. He was told there was no time for a full review. He was asked to give his personal assurance that the government would not challenge the deal under antitrust law. Roosevelt gave that assurance. He later said he had no choice, that the alternative was allowing the panic to deepen, that the acquisition was a necessary part of the rescue. He may have been right about all of that, but the outcome is not in dispute. Morgan came into the crisis as the most powerful banker in America. He left it having acquired a company with natural resource reserves that made U.S. Steel's dominance of American industry even more complete than it had already been. He had the president's personal guarantee that the government would not interfere, and he had done it all while being publicly celebrated as the man who saved the country. The rescue was real. The reward was also real. And the question of whether one was used to enable the other is one that historians have been debating ever since. What is not debatable is what the crisis revealed about the United States in 1907. It revealed that the most powerful economy in the world had no reliable way to protect itself when its financial system came under pressure. It revealed that the government, when it mattered most, had to go to a private citizen and ask for help. And it revealed that private citizens who provide that kind of help do not typically do so without getting something in return. That revelation changed everything. Because within 3 years of the panic of 1907, a group of men would gather in secret on a private island off the coast of Georgia. They would spend 9 days drafting a document, and that document would become the legislation that created the Federal Reserve, the institution that was supposed to make sure America never had to call a banker again. The story of who those men were and who they worked for is where this story goes next. 3 years after the panic of 1907, on a cold November evening in 1910, a private rail car pulled quietly out of a station in Hoboken, New Jersey. There were 6 men on board. They had not arrived at the station together. They had been instructed to arrive separately at different times so that nobody watching would connect them to each other. They used first names only, no surnames, no titles, no professional affiliations. The servants who accompanied them had been told they were going on a duck hunting trip to the coast of Georgia. They were not going duck hunting. The 6 men on that train represented something almost impossible to calculate. Between them, directly and through the institutions they controlled, they had influence over approximately 1/4 of the entire world's wealth. These were not minor figures. These were the men who decided, in practical terms, how money moved through the American economy. Senator Nelson Aldrich was there. He was one of the most powerful politicians in the country, chairman of the National Monetary Commission, and the father-in-law of John D. Rockefeller, Jr. Frank Vanderlip represented National City Bank, one of the largest banks in America. Henry Davison was a senior partner at J.P. Morgan and Company, Morgan's own firm, still operating at the peak of its power 3 years after the panic. Benjamin Strong ran Bankers Trust. Paul Warburg was a partner at Kuhn Loeb and Company, one of the most influential investment banks in the world. And Arthur Shelton came along as secretary to write down what was decided. They were traveling to Jekyll Island, Georgia. Jekyll Island was a private retreat owned by a club whose members included some of the wealthiest families in America. Morgan himself was a member. The island was remote, exclusive, and completely controllable in terms of who came and went. Nobody would see them there. Nobody would report on what they discussed. Nobody outside that rail car even knew the meeting was happening. For 9 days they worked. What they were building was the blueprint for a central bank, the institution that America had been without since Andrew Jackson destroyed the second bank of the United States in 1832. The panic of 1907 had made it impossible to argue any longer that the country could function without one. Too many people had been hurt, too many businesses had failed. The political pressure to do something was enormous. But here is where it gets interesting. The men drafting the solution were the same men who had profited most from the system that caused the problem. The bankers who had survived the panic, in many cases because Morgan had decided they were worth saving, were now designing the institution that would prevent future panics. They were writing the rules of a system they would then operate within. They were, in the most literal sense, designing their own referee, and they were doing it in secret. Now, it is important to say something clearly here. The Federal Reserve that emerged from Jekyll Island was not a simple act of self-interest. The men in that room were also genuinely concerned about financial stability. They had lived through the panic. They understood better than anyone how close the system had come to total collapse. They did not want that to happen again, partly because it was bad for the country, and partly because it was bad for them. Both things were true simultaneously. But the structure they designed reflected who they were and what they cared about. The plan they drafted gave significant power to private banks. Regional Federal Reserve banks would be owned by member banks, the same commercial banks that Vanderlip and Strong and Davison represented. Those member banks would elect the majority of the directors who ran each regional Fed. The system would be supervised by a board in Washington, but the practical machinery of monetary policy would sit inside institutions that were at their core privately owned. When Senator Aldrich brought the plan back to Washington, it faced immediate political resistance. Critics pointed out with considerable accuracy that the proposal looked less like a public central bank and more like a private banking cartel with government blessing. The Aldrich plan became politically toxic. Progressive politicians refused to support anything that looked like it had been designed by Wall Street for Wall Street. So the plan was rewritten, the names were changed, the structure was adjusted at the edges. A Democrat named Carter Glass took the lead on the legislation in Congress, and the Federal Reserve Act that passed in December 1913 looked different enough from the Aldrich plan that its opponents could be persuaded it was something new. But Paul Warburg, one of the 6 men on that train to Jekyll Island, reviewed the final Federal Reserve Act carefully. He knew the original plan better than almost anyone, and his assessment was direct. The changes were real, but the core architecture was intact. The institution that Congress created in 1913 was in its essential structure the institution that 6 men had designed in secret on a private island 3 years earlier. Warburg himself went on to serve on the first Federal Reserve Board. The meeting that was supposed to have never happened had produced the most significant financial institution in American history. And for 17 years, nobody confirmed it had taken place. The participants maintained their silence. The duck hunting story held. It was not until 1930 that Frank Vanderlip, by then retired from banking, wrote about the Jekyll Island meeting in a magazine article. By that point, the Federal Reserve had been operating for 17 years. It had already made decisions that shaped the lives of every American. And the story of how it was created, who was in the room, what they represented, and what they built was history that most Americans had never been given the chance to understand. But what matters more than the secrecy of the meeting is what happened after the Federal Reserve was created. Because the institution that was supposed to protect ordinary Americans from the kind of panic they experienced in 1907 would within 16 years of its creation preside over the greatest financial catastrophe in American history. And the decisions that led to that catastrophe were not made by accident. The Federal Reserve opened for business in November 1914. It was greeted with genuine optimism. After decades of financial panics, after the chaos of 1907, after watching a 70-year-old private banker have to personally rescue the American financial system, the country finally had an institution designed specifically to prevent that from ever happening again. A lender of last resort. A body that could inject money into the system when it came under pressure. A referee for the most powerful economy in the world. For the first few years, it worked reasonably well. Then, the decisions started. In 1919 and 1920, the Federal Reserve raised interest rates sharply. The stated reason was to control inflation that had built up during the First World War. The effect was a severe economic contraction. Businesses that had borrowed to expand during the war suddenly found their loans impossible to service. Farmers who had been encouraged by the government itself to buy more land and more equipment to feed a world at war found that the price of their crops collapsed while their debt payments stayed the same. In the farming states of the Midwest and South, the contraction of 1920 and 1921 was not a recession, it was a devastation. Farm incomes fell by more than 50% in a single year. Tens of thousands of farmers lost land their families had worked for generations. Rural banks that had lent to those farmers failed in enormous numbers. Over 5,000 rural banks collapsed during the 1920s, most of them in agricultural communities, most of them before the Great Depression officially began. The urban banks that held farm debt benefited from the deflation. When the value of money rises, the people who are owed money gain, and the people who owe money lose. The Federal Reserve's decision to raise rates transferred wealth in measurable and documented terms from borrowers to lenders, from farmers to banks, from the people furthest from the decision to the institutions closest to it. And then, having caused one crisis, the Fed helped build the conditions for a far larger one. Through the mid-1920s, the Fed kept interest rates low. Cheap money flooded into the stock market. Ordinary Americans, many of them the same people who had just lived through the farm crisis, many of them with no previous experience of financial markets, began investing in stocks for the first time. Brokerage firms encouraged them to buy on margin, meaning they could purchase $10 of stock for every $1 they actually had. The market soared. The newspapers celebrated. Fortunes were being made, at least on paper, by people who had never owned a share of anything before. By 1929, the stock market had become something that bore very little relationship to the actual economy underneath it. Prices had been driven to levels that made no rational sense by a combination of cheap credit, mass optimism, and the simple fact that prices had been rising for so long that most people had stopped asking whether they should be. In 1928 and 1929, the Federal Reserve raised rates again. The market collapsed in October 1929. Within 3 years, industrial production in the United States had fallen by nearly 50%. Unemployment reached 25% nationally. 13 million Americans lost their jobs. 9,000 banks failed. The savings of millions of ordinary people, people who had done nothing wrong, people who had simply trusted the system, disappeared. The Great Depression was not caused by any single decision or any single institution. It was the product of years of accumulated imbalances, policy mistakes, and structural weaknesses in the global economy. Historians and economists have debated its causes for nearly a century and will continue to do so. But this much is documented and not seriously disputed. The Federal Reserve, the institution created specifically to prevent financial catastrophe, made a series of decisions in the years leading up to 1929 that inflated the conditions for collapse. And then, when the collapse came, it made the situation dramatically worse by contracting the money supply at precisely the moment when expansion was needed. Between 1929 and 1933, the Fed allowed the amount of money circulating in the American economy to fall by 1/3. Milton Friedman, one of the most influential economists of the 20th century, and not a man given to dramatic statements, concluded after years of research that the Federal Reserve was primarily responsible for turning a serious recession into the Great Depression. Ben Bernanke, who would go on to chair the Federal Reserve himself, said at a conference honoring Friedman in 2002, speaking directly about the Fed's role in the Depression, "You're right, we did it. We're very sorry, but thanks to you, we won't do it again." That acknowledgement came 73 years after the fact. Which brings us back to where this story began. Morgan locked bankers in a room in 1907 because the country had no institution capable of managing a financial crisis. The men who witnessed that panic designed the Federal Reserve to fill that gap. The Fed was created with genuine intent to protect the financial system, and within 16 years of its creation, it had presided over the worst financial disaster in American history. The institution that was supposed to make America safe from the power of private bankers was designed by private bankers. The institution that was supposed to prevent financial panics helped create the conditions for the greatest financial panic the world had ever seen. And then, having caused one crisis, the Fed helped build the conditions for a far larger one. That is not an accusation, it is a history. The Federal Reserve is not the villain of this story. Neither is Morgan. Neither are the 6 men on the train to Jekyll Island. They were all operating within systems that rewarded certain decisions and punished others. They made choices that made sense within the logic of their moment, and those choices had consequences that stretched far beyond anything they anticipated or intended. But here is what that history asks of you. Every financial system is designed by someone. Every set of rules reflects the priorities of the people who wrote them. Every institution that exists today was created at a specific moment in time by specific people with specific interests, and understanding those origins does not make you cynical, it makes you informed. Morgan did save America in 1907. He also bought Tennessee Coal and Iron in the process. Both things are true. The Federal Reserve was created to protect ordinary Americans. It was also designed by the people it was supposed to protect them from. Both things are true. The system you live inside was built by human beings with intelligence, ambition, genuine public purpose, and private interests, often all 4 at the same time. Understanding that is not the end of anything. It is the beginning of seeing clearly.